Welcome back to The Explainer. Today, we're diving straight into the art of making fair, accurate industry comparisons using the SASB standards for the consumer finance sector. If you've ever stared at a pile of corporate disclosures and wondered how on earth you're supposed to compare a massive global bank with a regional lender, well, you're in exactly the right place. We're going to master a really critical tool called activity metrics that literally levels the playing field.
All right, let's kick things off with a quick hypothetical. Imagine Company A reports 500 data breaches in a year, and Company B reports only 50. Now, your immediate gut instinct is probably to say Company B is way safer, right? I mean, 50 is obviously a whole lot less than 500. But what if I told you that you don't actually have enough information yet to make that call?
Okay, let's dive into this. That scenario we just looked at, it's the classic apples to oranges trap in financial analysis. When you're comparing companies of vastly different sizes, looking at raw numbers is just completely misleading. To really see what's going on, we have to move from comparing raw data to comparing normalized rates. That is absolutely crucial for getting a true apples-to-apples comparison.
So here's our roadmap for today. First, we'll look at the raw data problem, then we'll introduce activity metrics, track unique consumers, track total accounts, and finally, we'll normalize the data. Let's get right into it.
Starting off with Section 1, the raw data problem. So, the SASB Consumer Finance Standard requires companies to report a handful of raw quantitative metrics. For example, you've got code FNCF 220A1 asking for the number of account holders whose info is used for secondary purposes. Then there's FNCF 230A1 demanding the number of data breaches, and FNCF 270A.4 tracking customer complaints. Now, these are super important pieces of info, but think about it. If a massive international credit card company reports 10,000 complaints and a tiny prepaid debit card startup reports 5,000, looking at those numbers in a vacuum doesn't tell the real story. The bigger company is just naturally going to have more of everything. We need a scaler.
Which brings us to Section 2, introducing activity metrics.
This right here is the exact definition straight from the SASB framework. An activity metric quantifies the scale of specific activities or operations by an entity, intended for use to normalize data and facilitate comparison. The secret sauce is right there at the end, normalizing data. That's the key to creating that fair apples-to-apples comparison we're after.
Now, what's really interesting about this slide is that SASB gives us the exact playbook. Table 2 from the Consumer Finance Standard lists the specific activity metrics we're supposed to use. Because consumer finance relies so heavily on revolving credit cards, and prepaid debit cards, SASB provides two distinct activity metrics to use as our denominators. Let's break those down.
Moving to Section 3, tracking unique active consumers.
Lock this code in your memory, FNCF000.A. A quick pro tip for you. Whenever you see a code ending in 000 in the SASB standards, you know for sure you're looking at an activity metric, not a risk disclosure.
So what exactly does FNCF-000.A measure? It counts the number of unique consumers with active credit card or prepaid debit card accounts. The focus here is entirely on the individual human beings. And there's a really neat technical nuance here called the joint account rule. Basically, for joint accounts, a company has to include the number of all customers whose personal info it collects. Why? Because if a bank collects data on two people for one single joint account, both of those people are at risk during a breach. Personal information collection literally scales the risk, so we have to count every single unique person.
Next up, Section 4, tracking total accounts. And here is the other half of the puzzle, FNCF000.B. This is your go-to metric for tracking the sheer volume of accounts within a consumer finance company. Just to make the difference crystal clear, FNCF00B measures the total number of credit card and prepaid debit card accounts, irrespective of whether they belong to unique individuals. Think about it. You might have 3 different credit cards with the exact same bank. Metric A counts you as one unique consumer, but metric B, it counts those as 3 distinct accounts. Depending on what raw disclosure you're trying to normalize, like, say, complaints about account fees versus identity theft, you'll pick either metric A or metric B as your most accurate denominator.
All right, the grand finale, Section 5, normalizing for industry comparisons.
Here is where the magic happens, and it's honestly incredibly straightforward. Step 1, identify the raw disclosure metric you want to evaluate. Let's use the number of data breaches again. Step 2, identify the correct activity metric. Since breaches compromise personal data, tracking unique consumers is the perfect fit. Step 3, simply divide the raw metric by the activity metric. Boom, that gives you your normalized per capita rate. Let's actually see this in action.
And this brilliantly illustrates the whole point. Remember our opening question? Company A had 500 breaches and Company B had 50. But look at the unique consumers column. Company A has 10 million consumers, while Company B only has 100,000. When we do the math and divide the 500 breaches by 10 million consumers, Company A's normalized rate drops to effectively 5 breaches for every 100,000 consumers. Company's rate, on the other hand, equates to 50 breaches per 100,000. So Company A, despite having 10 times the raw number of breaches, is actually 10 times safer per consumer when you scale it correctly.
And that is the core takeaway of our explainer today. Normalization literally protects you from getting fooled by skewed data. Without this extra step, you probably would have penalized Company A and rewarded Company B, which would have been a totally flawed decision. Using these activity metrics is absolutely non-negotiable for serious analysis. It is the only way to cut through the sheer noise of scale and spot the true sustainability leaders. So I'm going to leave you with this. Next time you see a flashy headline screaming about a massive number of complaints or data breaches at some major company, are you going to settle for the raw number, or will you dig a little deeper and calculate the normalized rate? Using the SASB activity metrics we cover today gives you the power to uncover the real story. Thanks so much for joining me for this explainer, and hey, keep asking the right questions.